Have you ever wondered what the smart way to invest is? Investing is more than just a game of numbers or a stroke of luck. It's a calculated risk, a strategic move, a way to secure your financial future. But with so many investment strategies out there, how do you know which one is the best? How do you ensure your hard-earned money is put to good use, growing steadily over time? The answer lies not in the elusive pursuit of the next big, but in a tried and true method that has stood the test of time. A method that takes the emotion out of investing, that smooths out the highs and lows of the market, and that can be your steadfast ally in your journey towards financial independence. This method is called dollar cost averaging. Now, you might be asking, what is this dollar cost averaging? We're about to find out. If you're finding this video helpful, don't forget like, comment, and subscribe to our channel for more investment strategies. So, what exactly is dollar cost averaging? Well, it's simpler than it sounds. Imagine you're an investor with a long-term perspective. You've got a specific sum of money you'd like to invest, but you're wary of the market's unpredictable nature. Here's where dollar cost averaging, or DCA for short, comes into play. Picture this: instead of investing your lump sum all at once, you break it down into smaller, equal amounts. You decide to invest these smaller amounts at regular intervals, say every month. Now this is where it gets interesting. You're investing the same amount of money each time, regardless of the price of the investment. Just think of it like a steady, unfaltering beat in the rhythm of your investment strategy. This rhythm remains consistent, whether the market is dancing to a fast, upbeat tune during a bull run, or swaying slowly during a bear market. So you might be wondering, what's the advantage of this approach? Well, it's all about mitigating the impact of volatility. By investing the same amount regularly, you're buying more shares when prices are low and fewer when prices are high. Over time, this can result in paying a lower average cost per share, hence the term dollar cost averaging. But remember, DCA isn't about trying to time the market or predict its movements. Rather, it's a disciplined approach that focuses on consistent investing, regardless of market conditions. It's about weathering the storm, not trying to predict when it will hit. And while there's no guaranteed profit or protection against loss, dollar cost averaging can help smooth out the bumps in your investment journey. It's a method that values consistency and discipline over trying to make a quick fortune. So as you can see, dollar cost averaging is a simple yet effective way to invest. But why is it considered smart? Let's delve into that. So why do investors consider dollar cost averaging a smart way to invest? Well, let's get into the nitty-gritty of it. One of the primary reasons is that dollar cost averaging can reduce the risk of making a substantial investment in an asset just before its price falls. Picture this: you've gathered up a sizable amount of money to invest. You decide to put it all in one asset, but lo and behold, the price plummets the next day. Now that's a tough pill to swallow, but with dollar cost averaging, you don't have to swallow that pill. Instead of investing a large sum all at once, you spread out your investments over time. This way, you buy more of the asset when prices are low and less when prices are high. It's a bit like a protective shield against the unpredictable twists and turns of the market. But the benefits of dollar cost averaging don't stop there. It also takes the emotion out of investing. Now, we've all heard the saying, buy low, sell high, right? But in practice, it's not that simple. Market timing can be incredibly challenging, and emotions often get in the way. It's all too easy to get swept up in the fear of missing out when prices are soaring or the panic when they're falling. But with dollar cost averaging, you don't need to worry about timing the market perfectly. You simply stick to your regular investment schedule, regardless of what's happening in the market. It's a strategy that promotes discipline and consistency, and it can help keep those investment jitters at bay. So in a nutshell, dollar cost averaging is a method that can help you navigate the choppy waters of the investment world. It can reduce the risk of making ill-timed investments, promote disciplined investing, and take the emotion out of the equation. And that, my friends, is why dollar cost averaging is considered a smart way to invest. It's simple, reduces risk, and takes the emotion out of investing. Now, doesn't that sound like a strategy worth trying? All right, folks, we've covered a lot of ground here on dollar cost averaging, but before we wrap up, we want to hear from you. If you found this video helpful, don't keep it to yourself. Give us a thumbs up and share this video with your friends who might be interested in smart investing strategies. And remember, we're here to keep you informed and empowered, so don't forget to hit that subscribe button for more investment strategies and financial tips. Now we know dollar cost averaging can be a bit of a mouthful to wrap your head around. So, if you have any questions, thoughts, or even experiences with this investment method, do leave us a comment below. We're always eager to engage with our community and hear what you have to say. Thanks for tuning in, and as always, happy investing.